The recent collapse of 3 U.S. banks has shaken the confidence of depositors and investors in the banking sector. Among the banks that are facing increased scrutiny and pressure are Huntington Bancshares, KeyCorp, and Comerica. These banks have high levels of liquidity and/or capital risk, as well as exposure to unrealized securities losses and other challenges. In this video, we will examine why these banks may fail after the recent run on banks and what they can do to survive. Huntington Bancshares is a regional bank based in Columbus, Ohio, with operations in 8 states. It has about $180 billion in assets and $130 billion in deposits. It offers a range of banking services to consumers and businesses, as well as wealth management and capital market solutions. Huntington has above-average liquidity risk and above-average capital risk, according to a report by Morningstar. This means that it may not have enough cash or equity to meet its obligations in a stress scenario. Huntington also has a high level of unrealized securities losses, which are losses that occur when the market value of securities held by the bank falls below their purchase price. As of December 31, 2022, Huntington had about $3.7 billion of unrealized losses in its available-for-sale bond portfolio, and $1.2 billion in its held-to-maturity bond portfolio. These losses could erode its capital if it has to sell them at a loss to raise cash. Huntington has faced an exodus of depositors and investor skepticism after the collapse of SVB Financial Group and Signature Bank, 2 banks that also catered to high-net-worth clients and had large unrealized securities losses. Huntington's stock price plunged more than 20% on Monday, March 13, 2023, amid fears of possible contagion and bank runs. The bank tried to reassure the market by issuing a statement saying that it had ample liquidity and capital levels, and that it was confident in its business model and strategy. However, analysts remain cautious about Huntington's outlook and ability to withstand further shocks. Steve Steinour, the CEO of Huntington Bancshares, has been criticized for pursuing an aggressive acquisition strategy that may expose the bank to more risks and integration challenges. In 2020, Huntington announced a $22 billion merger with TCF Financial, which was completed in 2021. In 2022, Huntington announced another $6 billion deal to buy First Horizon Bank. KeyCorp is another regional bank, based in Cleveland, Ohio, with operations in 15 states. It has about $170 billion in assets and $120 billion in deposits. It offers banking services to individuals and businesses, as well as specialized solutions for certain industries such as healthcare, energy, and technology. KeyCorp has average liquidity risk and above-average capital risk, according to Morningstar. This means that it may struggle to maintain adequate capital levels in a stress scenario. KeyCorp also has a large amount of unrealized securities losses in its available-for-sale bond portfolio. As of December 31, 2022, KeyCorp had about $6.4 billion of unrealized losses in its available-for-sale bond portfolio, and $597 million in its held-to-maturity bond portfolio. These losses could hurt its equity if it has to sell them at a loss to raise cash. KeyCorp has been under pressure from rising interest rates, which reduce its net interest margin. The net interest margin is the difference between the interest income the bank earns from loans and securities, and the interest expense it pays on deposits and borrowings. As interest rates rise, the bank's cost of funds increases faster than its yield on assets, squeezing its profitability. KeyCorp's net interest margin declined from 3.01% in 2020 to 2.81% in 2021. KeyCorp's stock price also dropped more than 10% on Monday, March 13, 2023, amid concerns about its liquidity and capital position. The bank issued a statement saying that it had strong liquidity and capital levels and that it was well-positioned to navigate the challenging environment. Chris Gorman, the CEO of KeyCorp, has faced pressure from investors and regulators to improve the bank's profitability and capital ratios amid a challenging environment. KeyCorp has also suffered deposit outflows following the collapse of 3 U.S. banks in 2023. Comerica is a regional bank based in Dallas, Texas, with operations in 5 states. It has about $90 billion in assets and $70 billion in deposits. It offers banking services to consumers and businesses, with a focus on commercial lending and commercial real estate lending. Comerica has average liquidity risk and high capital risk, according to Morningstar. This means that it may face difficulties in raising or retaining capital in a stress scenario. Comerica also has a significant exposure to commercial real estate loans, which could suffer from defaults or delinquencies in a downturn. As of December 31, 2022, Comerica had about $28 billion of commercial real estate loans, representing 31% of its total loans. Comerica also has a relatively low level of unrealized securities losses compared to the other 2 banks. Comerica also had about $1.1 billion of unrealized losses in its available-for-sale bond portfolio, and $89 million in its held-to-maturity bond portfolio. These losses could affect its capital if it has to sell them at a loss to raise cash. Comerica has been affected by the collapse of SVB and Signature Bank, which share some of its markets and customer segments. Comerica's stock price fell more than 15% on Monday, March 13, 2023, amid fears of possible contagion and bank runs. The bank issued a statement saying that it had ample liquidity and capital levels, and that it was confident in its credit quality and risk management practices. Curt Farmer, the CEO of Comerica Bank, has been accused of mismanaging the bank's exposure to energy loans and commercial real estate loans during the pandemic and its aftermath. Comerica has also faced lawsuits from customers who claimed they were charged excessive fees or denied loan modifications. Truist Financial is a regional bank based in Charlotte, North Carolina, with operations in 17 states. It has about $520 billion in assets and $390 billion in deposits. It offers banking services to consumers and businesses, as well as insurance, wealth management, and capital markets solutions. Truist Financial was formed by the merger of BB&T and SunTrust in 2019. Truist Financial has average liquidity risk and high capital risk, according to Morningstar. This means that it may need to raise more capital or cut dividends in a stress scenario. Truist Financial also has a large amount of goodwill on its balance sheet, which could impair its tangible common equity if it has to write it down. Goodwill is an intangible asset that represents the excess of the purchase price over the fair value of the net assets acquired in a merger or acquisition. As of December 31, 2022, Truist Financial had about $38 billion of goodwill, representing 35% of its total assets and 73% of its tangible common equity. Truist Financial also has a moderate level of unrealized securities losses compared to the other 2 banks. As of December 31, 2022, Truist Financial had about $3.9 billion of unrealized losses in its available-for-sale bond portfolio, and $1 billion in its held-to-maturity bond portfolio. These losses could affect its capital if it has to sell them at a loss to raise cash. Truist Financial has faced challenges in integrating BB&T and SunTrust, two banks that had different cultures and systems. The merger was expected to generate cost savings and revenue synergies, but also involved significant expenses and risks. Truist Financial's stock price dropped more than 10% on Monday, March 13, 2023, amid concerns about its liquidity and capital position. The bank issued a statement saying that it had strong liquidity and capital levels, and that it was well diversified across products and geographies. Kelly King, the CEO of Truist Financial, has been praised for leading one of the largest bank mergers in U.S. history with SunTrust in 2019. However, he has also faced challenges in integrating two different cultures and systems while maintaining customer satisfaction and loyalty. Truist has also lagged behind its peers in digital innovation and efficiency. These are some of the reasons why Huntington, Bankshare, KeyCorp, Comerica, Truist Financial may fail after the recent run on banks and what they can do to survive. These banks face significant challenges in the current environment, but they also have some strengths and opportunities that could help them overcome them. They need to manage their liquidity and capital carefully, reduce their exposure to unrealized securities losses and risky loans, and leverage their competitive advantages and growth potential. They also need to restore confidence among depositors and investors by communicating clearly and transparently about their financial condition and performance. By doing so, they may be able to avoid the fate of SVB, Signature Bank, and Silvergate Capital. Do you think these banks will also face a liquidity crisis and collapse, or do you think their CEOs will rise to the occasion and turn things around? I will leave you with this quote from Warren Buffett: "Banking is very good business if you don't do anything dumb." Thank you for watching, and don't forget to subscribe to our channel for more videos like this.